Hello everyone, I am very excited to welcome you back in this episode. The agenda for today is the key differences between IFRS and the US GAAP. As you know, there are too many differences between US GAAP and IFRS. It is very difficult to talk about all such differences in a short video. What I'm planning to do is to come up with a series called IFRS versus US GAAP consisting of 3 episodes. What you're going to watch now is the IFRS versus US GAAP, episode 1. International Accounting Standard Board has been working very hard to implement IFRS around the globe. And they have made great achievements so far, as most of the capital markets around the globe have made it mandatory for their listed companies to adopt IFRS. However, there are 3 significant capital markets have not yet implemented IFRS. Number 1 is Japan, where the implementation of IFRS for listed companies is only a voluntary requirement. And then in China, where the local accounting standards are somewhat in line with IFRS, however, a date for transition into IFRS has not been established. The last one is United States, where there are significant differences between US GAAP and IFRS. Let's take a look at the history. Before 2001, the global investor community thought that United States probably had the best accounting regime in the world. However, that was challenged in 2001 when Enron went into bankruptcy, which is considered to be one of the biggest accounting scandals in the world. After this major accounting scandal, investor confidence on the US accounting regime was severely shaken up. After this major accounting scandal, US Financial Accounting Standard Board and International Accounting Standard Board got together, came up with something called NOVOC Agreement in 2002 with a common agenda to eliminate the differences between US GAAP and IFRS and harmonize their respective accounting standards. There have been good progress made so far, and one of the biggest achievements is the harmonization of revenue recognition accounting practices between United States and IFRS with the introduction of IFRS 15, revenue from contracts with customers. However, despite the progress made so far, there are still significant differences between US GAAP and IFRS. It is very important to note that the listed companies in the United States account for 55% of the market capitalization of global equities, which would mean that until the differences between US GAAP and IFRS are fully eliminated, we cannot consider IFRS as truly international. Investors and analysts must be familiar with the differences between IFRS and US GAAP, because these differences can have a significant impact on an entity's bottom line, their balance sheet position, valuation, and the whole investment decision-making process. In this particular episode 1, we're going to talk about the key differences between IFRS and the US GAAP pertaining to non-financial assets, predominantly related to non-current assets and inventories. Let's take a look. Classification of non-financial assets. In IFRS, non-financial assets are classified into 4 major categories: property, plant and equipment, investment properties, intangible assets, and inventories. Owner-occupied properties are classified in line with IAS 16 property, plant, and equipment. On the other hand, properties held by an entity for long-term capital appreciation or properties held exclusively to generate rental income are classified as investment properties in line with IAS 40. But remember, in US GAAP, there is no classification of investment properties. Both owner-occupied properties as well as investment properties are classified as property, plant, and equipment in US GAAP. We're going to talk about the carrying value of non-current assets in the balance sheet. Initial measurement is going to be cost for both IFRS and US GAAP. However, entities who follow IFRS have two options for subsequent measurement of non-current assets: historical cost approach and revaluation approach, which would mean that entities who follow IFRS have an option to measure their non-current assets at fair value. However, in US GAAP, fair value accounting for non-current assets such as property, plant, and equipment and intangible assets are strictly prohibited. Therefore, in the US GAAP, entities need to account for their non-current assets at historical cost minus accumulated depreciation or amortization less impairment losses. It's getting a little bit more technical as we are going to talk about impairment of non-current assets. Remember, the impairment testing methodology is quite different in US GAAP and IFRS. And this is a very relevant topic today as due to COVID-19, many organizations are performing impairment testing and writing off significant amount of assets from their balance sheet. Before getting into the differences of impairment testing between US GAAP and IFRS, let's try and understand what we mean by impairment losses. An asset is considered to be impaired when its recoverable amount is below its carrying value, meaning that you have simply overstated the value of your assets in the balance sheet. And that is why impairment testing is important when you are using historical cost accounting to ensure that you do not overstate your assets value in the balance sheet. Now, let's focus on the differences between impairment testing in IFRS and US GAAP. In IFRS, in order to carry out an impairment testing, the first step is to identify the carrying value of the asset, which is nothing but the historical cost or the revalued amount minus the accumulated depreciation. Step number 2 is the most important one, is identifying recoverable amount of an asset. Recoverable amount of an asset is the higher of fair value less cost to sell and value in use. Fair value is the market value of an asset and value in use is the present value of the future cash flows that can be generated by using an asset. So fair value and the value in use must be compared, and we need to identify the highest value out of these two, and that becomes the recoverable amount. And then we're going to compare the carrying value and the recoverable amount to see if the recoverable amount is lower than the carrying value. In such case, there would be impairment losses. But remember, if the recoverable amount is greater than the carrying value, then we continue to record the asset at the carrying value as we are following historical cost convention in this particular case. Now, let's look at how this works in US GAAP. Now, we need to look at how to perform an impairment testing under US GAAP. Entities who are following US GAAP need to carry out impairment testing using a two-step methodology. Under step 1, entities need to compare the carrying value of their non-current assets with undiscounted future cash flows that can be generated by using the asset over the useful life. And remember, this is different from value in use in IFRS, because in IFRS, value in use is calculated as present value of future cash flows that can be generated by using the asset. But remember, in the US GAAP, the cash flows are not discounted. Suppose if the undiscounted future cash flows that can be generated by using the asset is lower than the carrying value of the asset, then entities need to move to the second step. In the second step, entities need to compare the carrying value of the asset with that of the fair value of the assets. And if the fair value of the assets are lower than the carrying value of the assets, impairment losses needs to be estimated and charged to income statement. Before we proceed to the next slide, we need to look at reversal of impairment losses. If circumstances have changed and the asset values have increased, IFRS permits companies to reverse impairment losses to the extent the losses were previously recognized. But remember, US GAAP strictly prohibits reversal of impairment losses, because if the reversal of impairment losses are permitted, it would become upward revaluation of non-current assets, which are not permitted in US GAAP. Intangible assets may be purchased or internally developed. Research and development expenditure is a great example for internally generated intangible assets. Both in IFRS and US GAAP, research expenses are expensed in the income statement. However, in IFRS, the development expenditure may be capitalized subject to meeting the conditions set out by IAS 38 intangible assets. Remember, most of the conditions in the standard focus upon establishing a technical feasibility, commercial feasibility, and having a high probability of developing a successful product. In such cases, development expenditure may be capitalized in IFRS. However, if the conditions are not met, development expenditure needs to be expensed. In contrast, in US GAAP, both research and development expenditure will be expensed into the income statement regardless of meeting the conditions. It is interesting to understand that COVID-19 vaccine manufacturers, if they follow IFRS, they may be capitalizing their development expenditure. However, in the US GAAP, they may be expensing all of their development expenditure related to COVID-19 vaccines. Software development expenditure is another example of internally generated intangible asset. And this can be broadly divided into two categories: software developed for sale and software developed for internal use. In IFRS, both software developed for sale and developed for internal use will be expensed until commercial and technical feasibility is established. It can only be capitalized when certain conditions are met. But remember, when it comes to US GAAP, software developed for internal use will be always capitalized. However, software developed for sale will only be capitalized when technical and commercial feasibility have been established. Something on depreciation methods, where we're going to talk about component depreciation. Complex assets with different components having different useful lives must make use of component depreciation in IFRS. This would mean different components of a complex asset must be depreciated separately based on their respective useful life. A good example would be an aircraft with different components having different useful lives must depreciate each component based on their respective useful life. Remember, the component depreciation is mandatory in IFRS. However, it is just an option in US GAAP. Therefore, many organizations do not make use of component depreciation in US GAAP. The method is seldom used. Something interesting on advertising cost. As we all know, any form of advertising cost is expense in IFRS. However, direct response advertising may be capitalized in US GAAP provided that there is future economic benefits. One good example for direct response advertising is social media advertising. This is going to be the last slide on episode 1, where we are going to talk about inventory valuation methods. Remember, historically, inventory valuation methods are very often used by entities to window dress their financial statements. Therefore, analysts need to pay particular attention to valuation of inventories. There are usually 4 methods of inventory cost flow methods available to value the inventories in the balance sheet, which are first in, first out, last in, first out, average method, and specific cost identification. Remember, IFRS prohibits the use of last in, first out. However, when you talk about US GAAP, all 4 methods, FIFO, LIFO, average method, as well as specific cost identification are permitted in US GAAP. US entities which are using LIFO methodology for their inventory valuation must disclose LIFO reserve as part of their footnotes. LIFO reserves can be used to convert LIFO inventory into FIFO inventory, which can be used by analysts for comparison purposes for comparing financial statements prepared under US GAAP and IFRS. In this episode, we looked at the key differences between IFRS and US GAAP pertaining to non-financial assets, which are predominantly non-current assets and inventories. I look forward to seeing you in episode 2. All the very best.